Commercial Propcast, the commercial property podcast where we look to answer the most common questions for anyone on the commercial property journey, whether you're an investor, business owner, or somewhere in between. The topics we discuss are of general nature only and don't consider your personal objectives or financial situation, so it's always best to obtain independent advice before making any commercial property decisions. Hey there, I'm your host Tessa Ng, and I'm the head of product at Real Commercial Australia. And as always, I'm pleased to be joined by my co-host David Story, who has spent many years in the commercial property industry, working across all asset classes in marketing and communications. David, hello. What are we talking about today, and who is joining us as our guest expert?
Hi Tessa. Yeah, it's great to catch up with you again. Look, we've uncovered some great insights from some of the industry's best over the past 4 weeks. And, looking forward to continuing that journey today. Last week, we focused on the main responsibilities of a landlord, and I'm sure all of our business owner listeners tuned into that episode. But today, that's exactly who we're focusing on, business owners, and exploring a theme of how to find the right property for your business. So to help us answer that question, we have Mel Pikos joining us. Mel is managing partner of Tactic Property in Queensland, an independent office leasing advisory firm that he set up with 6 other partners after an extremely successful career journey that included time spent with some of the largest global property and investment management firms such as Colliers and CBRE. And throughout his 15-year career in commercial real estate, he's negotiated over 200,000 square metres in office leases. And here's an interesting statistic to give that number some meaning. 200,000 square metres is the equivalent to the whole of the Empire State Building in New York. So, Mel, welcome to the Real Commercial Propcast. Some impressive numbers and obviously plenty of experience for you to share with our listeners today.
Yeah, thanks for that stellar introduction, David, and thanks, Tessa. Thanks for having me on the show. Look forward to providing some insights.
Hey Mel, so good to have you here with us today. So let's start with a question that I'm sure every business owner has had to consider when thinking about growing their business. So maybe it's time to make things real and kick off the business, or maybe it's gotten to a point where the business is going well, forecasts are looking good, and it's time to maybe move out of the garage or the spare bedroom and make it a bit more official. And that's when the decision to buy, lease, or get short-term flexible space might come up. So what are some of the things that our business owners should consider when making that decision?
I think it's really based on what sort of stage is your business going through at the moment. If you are coming out of the home office for the first time, or you've just employed a couple more extra staff members, what's your growth going to be like? Is it going to be stagnant? Are you just going to be 10 staff and then that's it? Or are you hoping to grow that to 20, or is it 50? What are the growth projections? I think getting an accurate indication of how much space you think you will need, whether it's short or medium or even long term, that's going to help guide whether you purchase a property or whether you lease a property, and to try and structure some longer term thinking around what your goals and objectives are for either that money or for your business itself. So I'd say the most critical thing is understanding how far do you really want to grow.
Yeah, thanks, Mel. It's it's an interesting one, isn't it? Having a really good appreciation for your own business strategy and being able to forecast accurately, which should help you in answering a question like that. But I might just ask you a couple of questions, from the leasing side then first, and then we'll follow up with one for, someone wanting to invest or buy. But let's have a look at the leasing side. A lot of landlords providing incentives to help entice tenants to commit to space. And that's obviously been, because of recent market conditions. But can you help our listeners understand how those incentives are calculated? What to expect when they're going through this sort of negotiation, and what they can expect to do with the money as well.
That's a fantastic question, David, because I think it's a question I get asked a lot, particularly if someone is a small business owner and they're probably taking either office space for the first time or not really too familiar with the whole process. Incentives are definitely an important part of the market, and it's just a way for landlords to encourage your commitment to the building. Typically, that the way incentives are structured is that it would be a contribution to your fit out, a rent reduction over the term of the lease, or a combination of both, which the latter is the most common. So for your listeners, a question that I get asked a lot, and certainly from people that inquire via your website, a question that always gets asked is, how do you actually work out what an incentive is? It's a fairly simple calculation. If you've finished grade 2, you can probably work it out. It's very easy. You simply take the rent that you pay in the first year, you multiply that by the term of the lease, and then you multiply that by the percentage that the landlord is offering. So here in Brisbane, a typical incentive would be about 35 to 40%. So that gives you a quantum of dollars that the landlord is prepared to contribute to your fit out costs or a rental reduction. So as an example, what we would typically say is, if a business could commit to about a 5-year term, that would cover around about the whole cost of your fit out in the current market. So that's just to give you a bit of an idea as to how you can use that money. If there's an existing fit out in place and they're offering you an incentive, and let's just say it's 30%, what that effectively means is that your rental obligation that you owe the landlord, they are able to offer you a 30% discount to that rent. So the reason why they do that is to try and inflate the capital values of their building. Effectively, landlords have become like a second style of bank. They're willing to give you some money to go and do your fit out or reduce your rent on the basis that they're going to, over time, recoup that over the term of your lease.
Fantastic. Okay, look, that's great advice. Obviously for those people who or business owners who are considering the leasing side. So that's the leasing side of the coin. But what if I'm a new business owner and I'm looking to buy an asset to occupy? Are there things that I really need to think about? You know, even something like providing security of my personal assets. Will I be required to, being a new business owner, provide security of personal assets? You know, what are the options? What do they need to look out for?
Yeah, certainly if you're a new business and still trying to prove things up, it might be a little bit harder to access that capital, because buying, say, commercial real estate or retail property or whatever it is in that commercial sphere, it's quite capital intensive. Oftentimes, it's not like residential where, you know, the banks will sort of let you get away with a 10 or a 20% deposit. More often than not, you need to provide equity to the tune of around about 50% of the capital value. So you need to sort of understand, if you do want to buy a $5 million building, can you provide $2.5 million worth of equity plus things like stamp duty and other costs? So that's probably an important consideration to consider as to whether or not that's within the realms of your possibility. The second tip I would give is, again, like I mentioned before, if you are a growing business and you anticipate that you're going to grow from 10 to 20 staff or 20 to 50, whatever that number is, the building that you buy needs to be able to facilitate your growth and expansion plans. It might be that you know that you're going to be 20 staff and that's all you're going to ever be. So you go and buy a 250 or 300 square meter strata or commercial office building, and that's it. You know that you're going to be quite stable for the next 10, 15, 20 years, whatever that might be. My advice that I would provide to your small business owners looking at purchasing is make sure that you're not confusing your investment strategy with an owner occupation strategy, because often they're two different things, and that's where people tend to sort of blur the lines. Often, if your building's growing, if your business is growing, you might be better off just going and leasing space and allowing the flexibility to move after 2 years, 3 years, 5 years when your business does grow, or contract for that matter, because it does happen the other way as well, where sometimes there is a planned contraction in a business, and you got to be mindful that if it's quite common that you see people buy buildings in, say, the self-managed superannuation fund, right? What I tell a lot of people is that if they're buying a building, their self-managed superannuation fund, and you're the tenant, do you really want to be putting your super into a building where you're knowing that you're going to contract out of it when you do want to retire. It's sort of counterintuitive. So you might be better off just going and buying a leased investment opportunity where you're going to get a stable, reliable return. It's not linked to your business. You're sort of creating that sever where you're able to move your business as it sees fit, based on your changing circumstances, but also of course, you still want to invest the money, particularly if you're making money, good money in your business, and you do want to go out there and invest it. Sometimes people try and blur those two lines, and it's not always the right investment strategy. But like anything, personalised advice is always the best.
That's really good advice, not to blur the lines, and I think that's a dangerous territory to get in. You're absolutely right. And so, are you noticing a trend where business owners are looking to purchase more because of low interest rates? Is that a trend that will continue? Is that a good thing to follow? I mean, you've just talked about blurring those lines between investment versus what your business strategy is.
Yeah, I think if we look historically, owner-occupiers, whilst it's not a new phenomenon, it's definitely been exacerbated off the back of low interest rates, Tessa. So it's definitely a great question. 5 years ago when rates are a little bit higher, we used to kind of joke that owner-occupiers are a bit like unicorns. Everyone wants one, but there's none of them around. Especially if you sat there with a vacant building, and I provide a lot of advice to landlords that own buildings, and they'd say, "Well, maybe you find me an owner-occupier." It was very, very rare previously. Now it's super common, and it is because of low rates. And we might be heading into a period where rates start increasing, so we might start to see a little bit of a pullback in that nature. But also, we've seen plenty of people buy a building, put themselves in on the lease, and then a couple of months later, it's back on the market for sale again, and they've leased it back. And so there's definitely an opportunity if you're a good tenant covenant, say you've got a solid business, and people know that. You can definitely capitalize on the value of your lease by buying a building and effectively taking the profit that is attributed by your lease commitment. Because at the end of the day, once a lease is in place on a building, that's when the value exponentially rises, because you've actually got something to value, right? There's an income stream that's being created by that building, as opposed to a vacant building, which, it's generally just a cost base because there's outgoings attributed to the building. So definitely trying to capitalize, if you are in the market to purchase, trying to maximize the value that would be attributed off the back of your lease. And that's where someone like a leasing expert might be able to help you out with designing that lease so that it's providing a maximum value for you at the back end.
Cool. So as a business owner, you've made the decision to buy, or maybe, you've gone the other way and you've decided to take out a lease. So then comes out the fit out part of the journey. So the onus is generally on you to complete that fit out, or at least coordinate it. Or we just spoke about incentives before, so hopefully your landlord has helped chip in there. But when it comes to fitting out the space, maybe you're redesigning it as a restaurant, or you're turning it into an office space. There's a lot of construction and labour that needs to go into that. And we know that the construction industry went into overdrive throughout the pandemic, and that pace hasn't seemed to have let up. And I, for one, know how difficult it has been to find builders and all types of labour just within the residential market alone. So are you seeing delays in completing fit outs due to labour shortages or material shortages in the commercial space as well?
Yeah, I think it's a great point that you raise. The funny thing is, over the last sort of 7, 8, 9, 10 years, building prices in office fit outs haven't really gone up. I've been quoting the same rate per square meter that I've been quoting for half my career. And it's because prices just haven't really gone up. And if they have, they've been marginal in nature. What's really changed over the last, probably more so the last 12 months, is that construction prices in fit outs, they've gone up by about 30%. And it's quite a marketed jump from when you've had years of stagnant growth within that sector. So it definitely is harder to get fit outs and trades and whatnot. We've gone into this industry with the thought process of trying to provide a one-stop shop for people, because it has been hard in that nature, which is why we've internalized it. Typically, fit outs take between 8 to 10 weeks to complete, depending on the size. Obviously, the bigger you go, that time frame does get pushed out. But we have seen that time frame push out to anywhere from 10 to 14 weeks. So they are a lot quicker than getting a residential building. There's a lot less factors to consider. The structure of the building's already built. You're going in there and basically fitting out workstations and power and data and whatnot. And there has been some pressure on trades, particularly anything to do with data cabling and whatnot. That's probably been the longest for us in terms of push out timeframes. But it's not as exacerbated as it is in the residential sphere. You could still get a fit out done within say even at 14 weeks as a worst case scenario. So it does mean that as a small business owner, you do have to probably plan a little bit more ahead than what ordinarily you would. Otherwise, there's also plenty of landlords that have gone out there and have done what we call spec fit outs. So they've speculatively gone and built these fit outs on the basis that they're removing one further barrier for business owners to be able to just sort of walk in and say, this fit out's already done. It might not be 100% perfect or exactly what I'm looking for, but it fits 90% of what I'm looking for. So that's acceptable to them.
Yeah, thanks, Mel. You've shared a lot of information today, and I guess that sort of proves that for the new business owner out there or someone looking to lease or buy, just getting some expert advice at the beginning is something that they should really look to people like yourself for, because just wandering around and doing your own research online or so just may not be enough. There's so many more insights that you offer. If we might have a few of those listeners as part of our audience today, but to close up our episode today, it'd be great if you could just share with us, what sort of businesses, maybe going through that expansion mode at the moment. Which ones are getting back into the market, as lockdowns end and we're seeing a little bit more activity in the market, because there may be a few of them listening. Which ones are you seeing that are really starting to get back out there?
What I think is really encouraging for your listeners is that the majority of the demand is coming from small, medium enterprise. It's not from the large corporates. I think a lot of CEOs who, might be in charge of large corporations, they've been reluctant to send people back into the office. And you notice that when I walk through big corporate office buildings that are leased by larger tenants that are taking up multiple floors, thousands of square meters, there's not a lot of staff within those offices. You walk into a small, medium enterprise, the managing director might be in the office or the business owner is there, or it's a very small organisation. They tend to be outperforming the bigger players, and they're going out there, they're recruiting, they're growing. Every broad-based sector, other than maybe, say, travel and tourism, I'd say also been the hardest hit. Everyone else is actually out there going, and they're absolutely smashing it. There's the strongest demand has been from small, medium enterprise. There's plenty of people that were working at home in their garage who have now gone and put on 5 staff, and all of a sudden they need an office for 10 people, and it's the first time out there looking. Or the businesses that are 10 people, they're out there looking for a 20-person office. The 20-person business is looking for a 50-person office. There is that continued growth from small, medium enterprise, whatever sector they're in, whether it's IT, engineering, mining, anything of that nature where they're just going out there and getting it done. So I think it's really comforting that there is a broad-based recovery. It is being led by the SMEs, the small, medium enterprise, and they're really outperforming their larger counterparts. It's time for the little monkeys to be stealing bananas from the big apes, and it's certainly a trend that I think is going to continue for the foreseeable future.
Yeah, good stuff. And I got to say, coming out of lockdown, or even during lockdown and coming out of lockdown, seeing the amount of innovation that's been going on and the number of really interesting business models that have come out of that and sparked out of that, and just seeing how so many of them have been successful continuing on out of lockdown and watching them on that journey, it's really, really exciting. So thank you though so much for coming along today, Mel, and sharing your insights. I'm sure that many of our listeners are feeling much more equipped on some things to look out for when picking the right property for their business. So thank you so much.
Thanks for having me, guys. Really appreciate it.
If you're hungry for more information, we actually have a section dedicated to small business on our news section on Real Commercial. So I'll link that in the show notes below. It's got a great range of content from guides and advice through to news and happenings. So do go check it out. There's some great content on there. But otherwise, thank you for joining us for another episode of Real Commercial Propcast, brought to you by the #1 address for commercial property, realcommercial.com.au. Don't forget to subscribe wherever you listen to your podcasts so that you never miss out on a new episode. Catch you next time.